Hello, good afternoon, ladies and gentlemen. My name is Victor Mills, Chief Executive of the Chamber, and it is a pleasure to welcome you to this Economic Outlook with Mr. Jameis Lim, Associate Professor of Economics at ESSEC Business School and Member of Parliament for Sengkang. Jameis, thank you for being our guest speaker today. We're looking forward to hearing your thoughts and views. In a few moments, I will invite Jameis to speak. Before that, I just want to share some housekeeping announcements. At any time during this webinar, you can type your questions into the Q&A function in the Zoom toolbar at the bottom of your screens. You can also like those questions which most appeal to you. I'll be back to moderate our dialogue with Jameis after his address, and now I will hand over to him to share his thoughts and views. Jameis, the floor is yours.
Thanks, Victor. And allow me to thank everyone for taking a slice of their time this afternoon to join us. My goal here is to provide you with an outlook, an economic outlook that will take both an international as well as segue itself into a more regional and domestic perspective. So hopefully you'll find it useful. I had planned for a number of remarks to begin, but I've often found that the benefit of these kind of presentations tend to be greatest when I'm responding more directly to questions. So if I don't end up extending the full hour for the purposes of the presentation, hopefully we'll make it up with additional value added in terms of addressing questions that the audience may have more directly. So let me just go ahead and share my slide deck here. All right, so let me just jump into it. Let me start, as I suggested, first with looking at the global picture. And here, obviously, we are interested first in the global macro picture insofar as the shorter run is concerned, at least for now. So the short run, as we all know, is the world is in a recovery. It's a very tentative and somewhat tepid recovery, but there's no doubt that the world economy is on the mend. That said, the conditions are fragile. If you look at the global picture in terms of growth engines, you'll see that it is primarily driven by both China as well as the United States. It's unsurprising, they are the world's largest two economies. But interestingly, of course, the argument that I'll put forth to you is that while it was the case that out of the 07-08 crisis, for obvious reasons, China was much more of the global growth engine then, pulling the rest of the world economy upward, including in some ways the United States. In this case, the US, as it turns out, is a little bit more of a global growth engine. And that is in spite of the fact that China is growing in a healthy fashion. But part of the reason why that growth is unlikely to spill over as much into the rest of the world as it used to in the previous crisis is mainly because of the granularity of China's growth this time around, which is more domestically oriented. Hopefully I'll be able to touch on that a little bit. Now, if you're also paying attention to a little bit of that market chatter, you will also be aware that there's all this talk about inflation and inflationary pressures. So the quick summary of my view on that is that I think it is mostly unfounded in terms of whether inflation will take off into something like what we observed in the 1970s and 80s, and that's not the case. But it is true that pressures are emerging, especially in certain pockets, and I hope to be able to touch on some of these in the moments ahead. So what you see in this chart is a summary of recent growth performance for the G4 economies. So this is the United Kingdom, the United States, the Euro area, as well as Japan. So the four advanced economies, but also the so-called BRIC economies, Brazil, Russia, India, and China. As it turns out, Brazil and India have since released both their first quarter figures, and it is positive. So of course, that is just prior, especially for the case of India, that doesn't bake into the cake the most recent challenges that India has faced. But nevertheless, positive growth numbers from both Brazil and India for the first quarter, which is obviously a solid improvement from the last quarter of the previous year when both were still contracting. Likewise, you will see that there has been obviously a big surge in growth, both in terms of the United States and China. This is exactly the premise behind why I suggested to you earlier on that it's the US and China that's leading the pack. Now, of course, these are unusual figures in many ways. To see a 6.4% growth rate for the United States, this is an advanced economy, is certainly very unusual. It's important to keep in mind, these are annualized rates. So what do I mean by this? Usually, when we measure growth rates, we think of it as the rate of growth for an economy over the course of the entire year. Now, in the case of the US, because we are measuring quarter-on-quarter growth, you have to annualize these figures, and that's exactly what's happening here. You'll see, in fact, in the previous quarter, the annualized growth rate for the US was even in excess of 10%. And in the first quarter, 6.4%, so still very, very solid quarter-on-quarter growth performances. Now, China's growth is much larger, but that is a little bit of a statistical artifact. And the reason is that for developing economies, we don't usually measure growth in terms of their quarter-on-quarter growth rates, but rather in terms of year-on-year. So what that's doing is measuring the growth rate in the first quarter of 2021 to the growth rate in the first quarter of 2020. And unsurprisingly, you'll see a huge surge for the case of China because, as we all know, in 2020, in the first quarter, we had the COVID shutdown. So in some ways, the 18.3 for China is a bit of an artificial statistical artifact that is generally not as big a deal. The fact that we measure growth rates in year-on-year versus quarter-on-quarter terms is not generally a big deal most of the time, but when you have very volatile economies like we see today, you have this tendency to see differences between growth rates that may be starker than reality might suggest. Now, that was where we were in the first quarter. What is useful is to ask ourselves where we might be headed. And here, what you see here are purchasing manager indexes. What these are what's sometimes called diffusion indexes. Basically, the people, the folks that calculate these, this is calculated by asking respondents, purchasing managers, whether they expect an expansion in their orders in the future, or whether they expect a deterioration in the conditions that they're facing as purchasing managers. And when you see a number above 50, that means that the majority of the respondents think that things are looking up versus the majority of respondents thinking that things are looking down. And what you'll notice, of course, is that as of, in fact, since somewhere in February or March, many of these respondents, the vast majority of respondents, are reporting much improved conditions. So usually something in the order of 51 to 55% will say that that's a positive sign, but it doesn't really represent gangbusters growth, but something in excess of 50%. You'll see the numbers there, they're in the 60s and in the high 50s. These indicate that these economies, the purchasing managers in these economies, are significantly optimistic about what's happening in terms of their orders, almost to a point where in some industries, you're starting to hear reports of supply crunches. You hear that in agriculture, for instance, a number of agricultural products as well as industrial metals are actually facing a shortage. Likewise, you may have heard of a global semiconductor shortage. And part of that is because of both demand. As people stay at home, people are much more likely to spend their disposable incomes less on goods and much more on services. So they're buying the new 55-inch TV, new consumer electronics, laptops, home vacuums, and so on. And at the same time, because of the rapid bounce back from a pandemic condition, which many suppliers are less accustomed to. They're more used to a much slower recovery that comes from a typical recession, so they didn't plan to have enough inventory. So it's both a supply and a demand story why right now we're starting to see a bit of a surge, especially in the manufacturing sector. But that, again, it's a surge that comes from a healthy position. The world economy is, especially in terms of industrial production, is steadily growing. Now, what about consumer confidence? This is the demand side of the story, and I've separated these into, on the left panel, you'll see consumer confidence indexes for major developed markets, and then on the right panel for major emerging markets. And here again, what this is surveyors going out and asking respondents whether they feel more or less confident about business and market conditions in the economy. And of course, unsurprisingly, these plumbed depths in the first quarter and almost the first half, depending on which part of the world you're looking at, of last year. And then that has since recovered very smartly. You'll see that they have bounced back in the UK, in the Euro area. You see they've bounced back in the case of Japan and the US. They're not quite as high as they were prior to the collapse, but essentially you're reaching a point in terms of consumer confidence, even in advanced economies that are lagging. By the lagging advanced economies, I'm primarily referring to both Japan and the Euro area. You'll see that these consumer confidence indexes have steadily recovered. Now, it's a little bit more of a mixed picture when you're looking at developing countries. Of course, in China, consumer confidence barely scraped the bottom, as you can see in the kind of a light red line on the right. But what you'll see is that in a number of these other economies, especially those that have still been struggling with pandemic management, you don't see as solid a recovery. Indonesia, in particular, in orange comes to mind, and you'll see that even in economies like Korea, which have also recovered steadily, that pattern is such that you don't see them reaching the pre-pandemic peaks quite yet. Okay, now what about when we start to look at the other dimensions of economic performance? So economists like to think about the short run prospects of economy being determined by production, employment, income, and sales. So these are all monthly level indicators that give us a very good sense of what's happening in the relatively high frequency of the various economies. So here I'm showing you sales, and in particular sales for advanced economies. And what you'll notice is that, of course, the United States change in retail sales has shot through the roof. This is unsurprising. In fact, retail sales was one of the sectors globally, not just in the US, that was least hit as a result of the pandemic. A big part of that reason was because of the shift essentially to online commerce, which meant that consumers, even though they were limited in terms of how much they could purchase, they continued to engage in sales nevertheless. It's just that they were over a virtual medium rather than over a physical store. And the consumer retail sales were also supported by government packages that ensured that consumer demand remained overall fairly healthy. So you'll see even among the laggard economies like the Euro area and the UK and Japan, you'll see that consumer sales, retail sales has essentially recovered and in some ways even exceeded their pre-pandemic norms. Now in EMs, again, you're seeing this separation depending on whether they've had more or less success with regard to pandemic control. So, of course, India, what we see here is a very solid rebound, but you are likely to see a pullback for India, almost the possibility of a double dip, in part because of what's happening in India right now. Don't get me wrong, India is past is vaccine, or rather pandemic second wave induced contraction, but that will nevertheless show up in the second quarter figures for India when it does get released. Now, so as you can see, there are some divergent outcomes. If you look at Brazil, you'll see that disposable incomes have not done as well compared to countries like India. And here's a slide that kind of underscores the point I was making to you about how China is really the first among equals, especially when it comes to looking at emerging markets. You'll see that according to industrial production, which is the data that I'm showing you here, you'll notice that industrial production for China has really outshone that of even other large emerging markets that have done well, relatively speaking. I'm thinking in particular of Korea. And you'll see that they haven't had the same kind of engine in terms of their industrial production as you see in the case of China. Now, what does this mean then when we translate that into actual numbers? Well, it means, unfortunately, that inflationary pressures are starting to rise. So what you'll see here in terms of the slides on the left and on the right, the left is the distribution of inflation among developed markets. So this is a selection of about 15 or so developed markets. And the kind of columns that you see are the inflation rates of the 25th as well as the 75th percentile. We try to rule out, in the case of inflation, a real outlier, so we don't look at the 90th or the 100th percentile for inflation. So we restrict it to the 25th and the 75th percentile, just to give us a sense of the distribution of inflation. You see that there isn't quite a lot of distribution in recent months. In recent months, the pickup in inflationary pressures is real, as well as geographically distributed all across developed markets. You see a little bit more quiescent inflation when you look at emerging markets. So if you look at the panel on the right, you'll see that there has been a recent pickup, so that little uptick in kind of since the beginning of this year for emerging markets. And also a narrowing in the distribution when it comes to different emerging markets, meaning that the increase in inflationary pressures is being experienced by emerging markets globally. But nevertheless, it's important to keep in mind that in both of these instances, inflation tend to be either close to or slightly below central bank targets. So in emerging markets, central bank inflation targets range from something like 4 to 6%. In recent times. So having a median inflation rate of 4% is actually generally close to the lower end of the distribution of inflation targets among developing countries. And if you look at advanced economies, likewise, you'll see that inflation is also relatively quiescent. Now, if you've been reading the papers, you'll be aware that in the most recent month, inflation in the United States actually crossed the threshold of 4%. And that has led to some consternation and gnashing of teeth. It's important to keep that in context, though. Usually, we don't want to place too much stock in inflation numbers for just 1 month. So I would say, let's wait to see the latest data for May, wait to see inflation numbers as they are printed for the subsequent months, and then to kind of take an average over this month to see whether some of these inflationary pressures truly are looking like they are more persistent in the order of 4%, or whether they are actually something that is a bit more transitory. And the Federal Reserve, as it turns out, is of the view that these inflationary pressures are going to be relatively transitory, and the main reason behind that transitory nature is because you often see inflation measured in terms of year on year. So once again, you're measuring the rate of inflation this year versus last year. And just because of base effects, prices essentially collapsed in the first quarter and the second quarter of last year because of the pandemic. And as a result of that, you will see this natural spike that again is purely a function of the arithmetic that comes from having grown off a very, very low base. So we will want to see how inflationary pressures are later on this summer, how they play out, as well as in the third quarter of this year, before we start to get worried that central banks and especially the US Federal Reserve will actually start to act in a more decisive fashion to arrest inflationary pressures by both a combination of tapering in their purchases of assets in financial markets, as well as in terms of considering lifting their short-term policy rates off what is essentially zero at the moment. Now, one other reason, or well, a number of other reasons to remain fairly sanguine about the ability of inflationary pressures building up is because we can look at other contributors to inflation. And what are some of these contributors? Well, one of them is going to be the extent to which we are seeing pressure in terms of wages. Now, don't get me wrong, it is true that in some selected sectors, you're starting to hear reports, anecdotal reports, that there is some difficulty in hiring, which obviously the standard mechanism to clear the market when you have difficulties in hiring is to raise wages. Again, that's not necessarily a bad thing from the perspective of the worker, but to the extent that this increase in wages ultimately gets priced into the prices of goods and services that are being sold, you will then see that translate into actual price inflation. One reason why economists have generally been relatively calm about this phenomenon as well is because the traditional channel of wage inflation passing through to price inflation has often not been operative over the course of the past 5 or 10 years. So it's not that we haven't seen some relationship between the two, but the pass-through has really been fairly weak. So to an extent that economists feel reasonably confident that, and just looking at the numbers here, for selected emerging market economies, you see that wage pressures, even when it does exist, is fairly low. And if it does pass through, it is unlikely to pass through in a rapid fashion that would be of particular concern in terms of showing up rapidly in price inflation. Now, what about other elements? Well, there is one area of concern, and that comes from money supply growth. And this has been an area of concern in part because if you listen to economists, if you listen to famous economists, what you often hear is a mantra that is sometimes repeated, which is inflation is always and everywhere a monetary phenomenon. That comes from Milton Friedman, who was a monetary economist in the University of Chicago, who coined the aphorism. And his argument was that, ultimately, when you see an increase in the money supply, that is what shows up in inflation. He is a bit of a kind of old school dyed in the wool monetarist, but nevertheless, it has influenced certain segments of market participants in thinking that this would be a concern. But what I'll point out here is this: there is undeniably a surge. You can see that surge on the right side of this chart, especially for the case of the United States. But importantly, inflation is a process. So what that means is that, yes, if you have an increase in the money supply, if you have a continued increase in the money supply month after month, quarter after quarter, that is a surefire recipe to see that being translated into actual inflation. But what you see here is you don't see that. You see a surge, that surge coming mainly from fiscal stimulus, coming from all these additional packages that the many developed market policymakers have rolled out to their different countries. But if you look at the more recent data, you'll see that that has tapered off. You don't see that huge upsurge that you saw in the middle of last year. And so that slowing down, it bodes well for keeping inflationary pressures under control. Now, moreover, if you look at expectations, what you see here is short-term inflation expectations. So these are expectations that are extracted from market data. Essentially, there are these financial market instruments called swaps. We look at them over the 5-year horizon. And these 5-year swaps are the market way of pricing in the possibility that you might see inflation in excess of in excess in general, insofar as they are being priced in by financial markets in terms of US treasuries as well as the bonds for all these other areas. And what you'll see is that, with the exception of the United States, which is this solid dark blue line there, you see that inflation expectations have risen significantly in the case of the United States. So to a point where it has exceeded 2%, which is the official Federal Reserve target. But in the case of the other economies, you don't see any kind of a surge. In the case of the UK, you do, in the case of the Euro area, you do see an increase, but the increase is only back to where expectations were prior to the pandemic, and more importantly, that still remains reasonably below what we would want, what the European Central Bank would actually want. So the European Central Bank's official inflation target is close to, but a little bit below 2%. Operationally, you can think of that as something like in the order of 1.8%. And at the moment, inflationary expectations in the euro area definitely remain below that. And even if you look at inflationary expectations in the US, you do hear arguments that justify this increase in inflationary expectations. And what is the justification? It is that the Fed is now in a new regime where it is allowing for the possibility of inflation to average 2%, which means that, well, given that inflation was significantly below 2% for a period of time, if you want your average inflation to actually hit the target of 2%, then you need to let inflationary forces run a little hot in the something like 2.5% for a number of quarters before you actually start to crank up your interest rates in order to quell some of this inflationary pressures. Now, if you look at another source of pipeline inflation, that is in terms of commodities, what you notice is that you see increases in all of them over the course of since the end of last year through to today. The increase has been more stark for agriculture. So agricultural goods, as I alluded to you earlier on in this presentation, undoubtedly is seeing a surge. And in fact, that surge is starting to plumb heights that are comparable to what we saw during a panicky time when where commodity price inflation was high across many categories of primary products. But what you'll notice is that in terms of metal prices, as well as energy, and especially energy prices, and if you fill up your tank in recent times, you have noticed that energy prices are still quite a bit below. They've been capped in the order of between $60 and $70 a barrel. So that's a fairly standard trading range ever since the advent of the shale revolution, and we expect that this will continue on into the future. And industrial metals have admittedly picked up as well, and again are starting to price in levels that are comparable to what we saw in the panicky period right after the global financial crisis, where there was inflation across all the different classes of commodities. Now, one last slide on the short term, and that is in terms of looking at inflation, decomposing this long-term inflation rate. So the inflation, the long-term interest rate. The interest rate can actually be broken down. So what you see in the red line right up top for most of the chart until in recent times is the actual nominal rate. So this is the interest rate for the 10-year US Treasury. And that can be decomposed into various components, into an inflation expectations component, into what's called the term premium. You can think of this as the risk inherent in investing in a 10-year US bond, and finally a term premium. And what the term premium is, that was the term premium. And then finally the long-term real rate, which is basically the real cost of capital that comes from a mix of supply and demand of loanable funds. And if you look at those, you'll notice that while it is true that the term premium has risen, and likewise inflation expectations have risen, as I showed you earlier on, because long-term nominal rates have been fairly flat. They have picked up, but they've been fairly flat over this, certainly compared to the rate of increase in both inflation expectations as well as the term premium. What you will see is that this means that the real rate, the real cost of capital has actually fallen. So what this means is that opportunities for investment in the real economy are certainly still available and still out there. And in fact, if you look at that long-term real rate, it remains negative, which means that investment opportunities are certainly there for the taking. Now, switching gears a little bit to the medium to the long term. So what I want to do now is to point out, pull together some of these trends excuse me, that seem to be prevailing in the global economy. And the main message I want to channel to you in this segment is actually that a lot of these trends were actually well in place before COVID-19. So while it may be the case that COVID-19 has led some people to pay attention, it may have led others to re-examine the phenomenon, but really many of these forces were already in place pre-COVID-19. Now, what are some of these forces? Well, one of them is the fact that global integration, and by global integration, I'm referring to the four main channels of international exchange. So exchange of trade in goods and services, international financial, or what's sometimes called capital flows, as well as the movement of people, migratory flows, whether in the short run, as in tourism, or in the medium to the longer run, as in immigration, whether for work or more permanently. And then finally, the fourth channel of transmission is that of knowledge or information. So the message I want to convey to you is that if you look at the first three of these flows, trade, finance, as well as migration, you'll see that these have downshifted. So these downshifted way before COVID-19, and I'll give you a couple of slides in a bit to underscore my point. And the one flow that has actually gone in the opposite direction, and we are right now, the fact that we're having this webinar on Zoom is a testimony to that, is that of information flow. So information has become a lot more digital, a lot more knowledge intensive, and that has accelerated as a result of COVID. But the others have actually downshifted over time. So what happened in 2007 and 8 after the global financial crisis was that the world openness to trade, by openness to trade, what this means is the amount of imports and exports as a share of global GDP has actually retreated. So if you look at this index, you'll see that that this has occurred in phases. So it's not like the world has never retreated from this process of globalization. We saw a process in the 1800s through to the eve of the First World War, where there was a wave of globalization. This was the wave of globalization that prompted many to observe that there was no longer going to be any kind of future conflicts because the world was so integrated commercially. As it turns out, 2 world wars put an end to that false notion. But nevertheless, you will see that there was an increase in the degree of openness, trade openness, and trade integration up till the First World War. And then there was a retreat during the course of the next 2 world wars. And then what did we notice? After the Second World War, there was an increase in globalization again, both a recovery up to the 1980s. And then after the 1980s, there was in fact an acceleration. So if you recall, for those of us that have been paying attention in the 1990s and 2000s, there were a lot of protests started in Seattle in the US and about this kind of globalization gone amok and how globalization would eat everything. As it turns out, that process actually began in the 1980s, especially with an increase in capital flows in the 1980s. But basically, you see this acceleration that took place in the 1980s through till the eve of the 2007 and 8 crisis. And what we have seen since then is actually a retreat once again. So sometimes known as slowbalization, portmanteau of the word slow and globalization. Sometimes people call it deglobalization. I don't think we have enough years in this new regime to quite justify a permanent deglobalization, but certainly there has been a slowing down in the rate of international trade integration over time. And we see this retreat also in international financial flows. As a matter of fact, if you look at cross-border capital flows over time, you'll see that after the 07-08 crisis, this has never recovered. So if you look at the peak, that peak was attained sometime in 2007, and in nominal terms, those have never recovered. And even as a share of global GDP, you'll see that in 2010-2016, the amount of capital, cross-border capital flows is about 2/3 that prevailed at the peak just prior to the global financial crisis. So we have had a slowdown after the global financial crisis of 07-08 in both trade as well as capital, but people flows had remained robust. That those people flows then were hit, as we all know, by COVID. So that was the final nail in the coffin. The third flow had then significantly retreated. This has not recovered. The data are a little bit dated, granted, but if you look at the latest data, as we all know, tourism has not recovered. There's been certainly an improvement in domestic tourism, especially if you're a large enough country. Singapore, going to Sentosa or Pulau Ubin doesn't quite constitute international tourism. But if you look at international travel flows more generally, you'll see that tourism indicators are significantly down over time. And here's the one beneficiary of this new global regime, and that is that information flows have remained ascendant. And they have not just remained ascendant, but in many ways accelerated during this latest phase. We have seen a pickup, of course, notably from China, that is that purple bar that you see crisscrossing all the others, but basically the expenditures on knowledge, R&D by some of these leading advanced economies as well as leading emerging economies is that there is a clear recognition of the importance of how the new normal, if you will, or perhaps you can call it the new normal, because the new normal was supposed to be what happened after the 07-08 crisis, will increasingly tend toward elements of a weightless economy, knowledge transfers, information transfers that are ultimately weightless in nature. And then what does this mean in terms of global configurations? Let me leave you with one thought before I turn a little bit more toward domestic and regional concerns. And what you see here is that ultimately, we might expect a process of fracturing into regional poles. So this is a phenomenon that predated not just the 07-08 crisis. It was a phenomenon that you can date back even prior to the 07-08 crisis. So here are data from 2004 to 08, and you'll see that essentially there are 3 major growth poles, if you will, from which growth emanates, and then a number of kind of secondary poles. Secondary poles include what you see there in the case of Russia, for instance, and to some lesser extent, India. But the 3 major growth poles, unsurprisingly, are China, the Euro area, as well as the United States. So these are growth poles from which spillovers in terms of their growth activities tend to emanate through the rest of the world, but especially to their regional partners. In the case of the US, it tends to be both North as well as South America. In the case of Europe, it tends to be Eastern Europe, as well as to a lesser extent, the Middle East and North Africa. And of course, in the case of China, it is growth that has spilled over undoubtedly towards Southeast Asia, but also to some extent, the effects of China's growth has also benefited even other advanced economies in the region, notably Japan. Now, what are our takeaways? So I see that I've gone on a little more rambly than I thought I would, but let me get to implications for this that will be perhaps of significant interest to this audience, and that is in terms of what it means for Singapore business. So I want to leave you with 3 takeaways in this new normal. The first is that while it is true that Singapore will emerge from this crisis, there's no doubt about that. And in fact, I am firmly with the consensus, in fact, on the upper end of consensus estimates for thinking that our growth numbers in both the second quarter as well as for the full year would be on the high side of what has been projected by Ministry of Trade and Industry as well as market forecasters. So it's no doubt that Singapore will emerge from this crisis, but it can only thrive beyond that if it also transitions toward a different model of growth. And I'll talk a little bit more about that different model of growth. But one important element of that new growth model, in my view, surely must rest in a more regional mindset, a focus much more on an ASEAN as the main interland and the main market, rather than, and I know here I am decidedly not part of that consensus, much more than I think there should be a focus on even China, and one where we also pull up not just the traditional engines of our economy, which has centered on the multinational firm, but also one where we see profitability and productivity in our small and medium enterprises also being uplifted. And that will be what will allow the economy to thrive in the future. I'll give you a couple of slides later on that will hopefully illustrate the points I make. Now, companies should also be positioned to take advantage of this centrism, this ASEAN centrism, this regionalization process. And unsurprisingly, the way to do that, especially from our tiny little red dot, is to ensure that digitalization becomes a key part of the operations of your firm. And now, obviously, this in turn will translate into what I believe to be a productivity surge, right? Because we have been waiting for quite a while for this digital revolution, this Web 2.0 revolution, in terms of its emergence in the data as a general purpose technology. The first surge we saw from this ICT revolution actually happened much after the invention and the rollout of the personal computer. In fact, Bob Solow, MIT economist, that has since he used to say, you can see, he said this in 1983, you can see the productivity, you can see the computer revolution everywhere, but in the productivity statistics. And he wasn't wrong, but he was certainly early, because what then happened is that we saw this surge in productivity in the 1990s. Now, likewise, we haven't seen the effects of digitalization of mobile technology, Web 2.0, and even the benefits of artificial intelligence and big data, in the big data revolution up till now. And my argument is, because of COVID, you are going to see this actually play out much more because firms have been forced to adopt, and that process of forced adoption and diffusion means that we're going to start to see this surge happening in the productivity statistics. And this will be an important counter to that kind of much more pessimistic narrative that we had seen up to now about why we see this languishing productivity all over the world, not just in Singapore, but in all advanced economies. And then the final point I want to bring across to you is how unsurprisingly, if we want to succeed in the knowledge-based economy, if we want to succeed in boosting productivity, what we really need is public-private partnerships that have followed much of the Singapore model up till now, but we need to make sure that those operate seamlessly in order to boost these channels as a medium for success. So here are the positive prospects for, so these are, what I'm showing you here is a survey for professional forecasters. So the Monetary Authority of Singapore goes out and surveys professional forecasters for the Singapore economy and asks them for projections. And what you'll see in both the dash black boxes and then subsequently the orange bars are the revisions in terms of expected GDP, and you'll see that those revisions have essentially favored an improvement in prospects that most economists, most professional forecasters have for the Singapore economy for 2021. And again, just to reiterate, I share the optimism. I do think that we will do better in the order of 5 to 6% this year, and that is in part because of what has been fairly smart recovery. We are already starting to see that in the first quarter data that has been released, and I think we'll continue to see that in the second half, especially when a lot of these support packages start to feed into the rest of the economy and show up in the data, and we become a lot more comfortable with substantial vaccination to open up the economy and not have these kind of rollbacks into phase 2, heightened alert, and so on and so forth, even when we have a nominal increase in cases. Now, why I mentioned that even after this improvement, though, potential will be limited, it is because Singapore has traditionally relied on a model where growth was driven by the accumulation of factors of production. What are these factors of production? These are labor. So during our rapid growth period in the 1970s through to the 1990s, we had the benefit of the tailwind that came from the demographic, the baby boom, the post-war baby boom that came from them, and how they joined the workforce. We've had the benefit of this group actually becoming more and more educated, and when that was exhausted, we then had new foreign talent come in to bolster the amount of contribution from human capital. We've had a lot of physical capital accumulation, both from FDI as well as forced saving coming from CPF funds that then were rechanneled back into the economy in terms of domestic investment. So all that, well and good, it led Singapore from where it was to what we see today. But if you look at the blue bars, that is the average technology contribution, or another word for that is productivity. You'll see that on average, our productivity has been dismal. So we have not had a lot of innovation as a mechanism for driving growth in Singapore, which means that unless we are able to really get this up into the future, the gains that come from either physical or human capital accumulation or labor, these will have been exhausted. And what we are left with then is a rate of growth that is going to be very, very low in the future, averaging 0, which we don't want to see. Now, this doesn't mean that we're growing poorer because, of course, the population is shrinking. Per capita terms, GDP will continue to rise. But in terms of headline growth, we might not be expecting the kind of growth rates in the order of 7 or 8% that we have become used to. Now, in terms of looking at Singapore businesses and how they should adopt a regionalist mindset, here's one chart to underscore how important this is. Look at the amount of trade that Southeast Asia has with itself. And that is what you see in the maroon line here. Southeast Asia tends to trade heavily among themselves. It's changing a little bit. We're starting to see increasing trade, of course, with China. But nevertheless, ASEAN has guaranteed this huge amount of flows of goods and services among ourselves, and therefore it's imperative that we tap into these flows and recognize that really our hinterland is in Southeast Asia, being situated in Southeast Asia rather than further afield. And what I want to show you in terms, I guess the chart that I was going to show you here didn't quite come through. But what I wanted to show you here is where the next middle class will actually be. And that next middle class, as it turns out, will be mostly in our neighborhood, Southeast Asia, primarily emanating from our largest neighbor population-wise, which is Indonesia. And you see that, of course, the middle class in Indonesia is different from the middle class that you might expect even in Singapore or in other advanced economies, but nevertheless, these are middle classes, global middle classes that will have an increased amount of cash with which to spend, and that will be one of the major drivers for our businesses as we look to expand markets into the future. And then what we need to do then is to pair this with digitalization. And I wouldn't have the time to talk about the process of digital transformation, but the key takeaway behind the process of digital transformation is that this digitization has to really infuse itself into every element of your business, not just a matter of bringing in a number of computers and calling it a day in terms of digitalization. Rather, it has to change the way you operate in terms of how you do business. It has to change the way in which you interact with your employees and giving them a lot more leeway with which to make judgment and decision making, because they have the digital tools with which to do so, and in terms of the nature in which you deliver your products, right? In terms of whether it would be by mobile or whether it would be through a web front e-commerce platform. Now, I guess I'll wrap up. Not as early as I would have liked, with some thoughts about productivity. And here, as I've already mentioned, you'll see that no matter how we project our productivity in future, it's going to be dismal, unfortunately. It is either going to be negative or hugging very, very close to zero. So the key that we want is to actually realize that, unfortunately, these images likewise did not come through. But what I wanted to show you here is that not all innovation needs to be the kind of disruptive innovation that is unicorn scale. Rather, you can imagine that there could be innovation that comes from more prosaic forms, right? Like process innovations. And process innovations, so business schools like to have this 2x2 chart for how you illustrate innovation. That was the slide. That's what should have shown on this slide, but essentially the point I wanted to make here is that you don't have to expect the innovation always needs to be the kind of large-scale innovation that brings us something like a Microsoft or something like an Apple. Rather, you can have process innovation, and that kind of innovation is still going to improve productivity in your economy and is still going to build your business and expand your customer base. And then finally, it's not true that innovation must be this kind of spark that comes. The slide here would have shown you a typical what's called design thinking process. So design thinking is something we teach in business schools as well, for ways that you can brainstorm and channel innovation in a fairly systematic manner. Again, to go into that will require an entire course, but nevertheless, the point I want to underscore is that it is possible to actually teach elements of a process of innovation, and we shouldn't think that this innovation only comes purely through inspiration. Okay, so it is 3:57. I've gone on for close to an hour now, so I will stop, and I'm happy to take any questions you may have.
Thank you very much indeed, James. That was a very interesting presentation. And before we turn to the Q&A in the box, I've just got a couple of questions I want to ask. I was fascinated by your focus on ASEAN. You know, that idea of ASEAN as our next area of economic growth and prosperity. And of course, it's been fascinating because if you look at because of the history of Singapore as an independent republic, when we became independent in 1965, we looked to the developed markets for foreign direct investment to kickstart economic development. And in many respects, I think, and I wonder if you share this view, many of our homegrown businesses today know less about our immediate region than their fathers and grandfathers did back in the 1960s.
Mhm.
And it's a kind of an unintended consequence of what at the time in the 1960s was a very necessary step, because we were kicked out of the Malayan Federation, and the economic gurus and the political pundits universally agreed that, you know, we were too small to survive as an independent economic unit, and we would metaphorically and even literally sink beneath the waves. So the only way was up, and the only way to really get things going was FDI. Would you agree with that kind of analysis?
Yeah, so there's no doubt that the main channel for growth in the 1960s, 70s, all through to the 90s and even early 2000s has been this importation of FDI. Now, don't get me wrong, this is not necessarily a bad thing. And in fact, we often think of FDI as something that just brings kind of financial capital. But actually embedded in the FDI is also technology and knowledge. So for a long time, Singapore, not being at the forefront of global technology and ideas, as we were still a developing country, had to import these ideas. And that was well and good. It led to the prosperity that we see today. And it was an important mechanism to channel prosperity. Two other points I would like to make. One is that while I did emphasize that ASEAN is the future, one of the shortcomings I think that we oversee in terms of the importance of ASEAN as an hinterland is the importance of us Singaporeans, as well as those based in Singapore, to gain a certain degree of regional expertise and experience. So what that means is, if you are a PMET, you should be a lot more comfortable with the possibility of spending half a year in another regional capital, trying to understand that market, because it is true some time that you spend in some of these other parts of the region, more than, you know, a 1-week holiday to a resort in some of these countries, in order to deeply understand the mindset of this country. I think, as you alluded to, Victor, our forefathers in that pioneer generation deeply understood our embeddedness in the region a lot more, I think, than we do today. We still sold to the world in terms of the goods and services that was made by Singaporean companies, you know, first with information technology in terms of semiconductors and chips and hard drives. We were the global manufacturing hub that we sold to the rest of the world. But importantly, we still understood that we resided within a region. We were one of the pioneering members of ASEAN, and that understanding of the embeddedness, I think, was very critical. What I'm suggesting now is that we should take the next step of not just thinking that we are embedded within the region, but to actually see it as also a market opportunity. And that's my second point, which is that I think a lot of businesses often think of China as the business opportunity. And there's no doubt about that. You know, if you can sell to just one province in China, you can make it big in one province in China just by sheer volume, right? China's just so many customers. You know that you can make it just because of its scale. But it's really hard, I think, to compete in China, because even among the best equipped Singapore firms with superior technology, they go there. The Chinese are so quick, so innovative, and they understand their home market so well. You have that competitive advantage for a number of years before you're outcompeted. So you do have, you know, the market is there, and it's certainly lucrative. But my suggestion is that it's actually a short run proposition, as opposed to something that could be more enduring for the medium to long run, if you do foster and develop a market closer home in Southeast Asia.
Thank you. And it's interesting that you talk about the need for um, more of us in Singapore to live and work in the region to better understand how those societies work and function, how business is done, and what the opportunities are, what problems consumers have, for example, in Indonesia, that we might be able to collaborate on in order to resolve.
Mhm.
And that sort of dovetails in with some thinking I've had on, the whole issue of productivity, which you spoke about, and how the outlook is not that rosy unless we change. And I think one of the things we need to change is our attitude, an attitude that is more regionally focused, and that where people are prepared to spend work assignments for a reasonable period of time. You talk to companies in the chamber and they'll tell you that they can get people to go pre-COVID, of course, to Geneva or Tokyo or Berlin or Toronto, but they can't get them to go to Surabaya or Hanoi or Manila, and that's a big shame. And I think the productivity angle, there is a real attitudinal issue there that we need to be honest about and find ways of addressing.
Yeah. So my impression is just to make it clear. Again, I mean, you guys are on the hiring and promotion front, but my impression is the way that we will want to convey that much more cleanly and clearly, in addition to the fact that I think an expatriate lifestyle in some of these countries actually can be quite positive. I mean, I would spend 2 years in Hanoi in a heartbeat. But one other element that is important to convey is the opportunities that it subsequently opens up for you in terms of promotion. So I've spoken to so many managers that have said, the difficulty we have in trying to push up some of our own homegrown talent is that they are a lot less willing to spend some time in the region. And so when I want to have a regional manager, it becomes a lot harder to push someone who doesn't have that regional experience into that kind of advanced role. So to make it clear that there is a promotion path, that even if you didn't, spending some time in Bangkok isn't your cup of tea, is nevertheless going to be a tremendous opportunity for you in terms of your career, at least in deeply understanding one or two other regional markets.
Yep, we've been saying this for years, and I agree with you. One more question from me before I wear out my welcome with our audience, and that is the G7 finance ministers at the weekend came together and more or less have agreed that there should be a minimum global corporate income tax starting at 15% at least. What do you think is going to be the implications for tax revenues and also for Singapore?
So interestingly, Singapore, as we all know, is a relatively low tax country, right? Both in terms of corporate tax as well as individual income tax. So we have, for a long time, benefited from a little bit from that arbitrage. But I think, in part, this would have been perhaps, in my view, a more significant worry maybe 10 or 15 years ago, when we hadn't kind of beefed up a lot of our anti-money laundering and know your customer elements. And why I say that is because after we have done a lot more of this AML and KYA, we have already kind of absorbed a lot of these, or rather moved on from relying more on the shadow economy and shadow capital flows. So to the extent that we are relying on kind of a regulatory arbitrage, is no longer as strong as it used to be 10 or 15 years ago. So in a sense, we did that 10 or 15 years ago, in part because of responses about becoming an international tax haven and so on and so forth. But I do think that that medicine that we had to roll out in the past has put us in good stead now. that we aren't as reliant as we used to be on the kind of regulatory and capital arbitrage that would have made us very uncomfortable if you have this kind of global agreement in corporate taxation that would effectively try to rule out some of this arbitrage.
Thanks. Let's now, as promised, look at what's in the Q&A. It's a sort of mixed bag of questions on a couple of themes. But let's take one from Paul first of all. So he says, in your view, what are the main threats to economic growth in 2021 and 2022 as the world is getting more vaccinations and so on, albeit faster in some countries and slower in others? What do you see as the main threats?
So maybe one of the messages that may not have come out as clearly as I would like is that there is clearly a diversity, a divergence in the kind of economic performance between different countries. More obviously, we see even among advanced economies, the Euro area and Japan lagging that of the United States in terms, and the UK in terms of how they're performing. And even among emerging markets, Russia and Brazil have lagged that of China. So for me, this divergence in economic performance, so one risk would be, it depends on, I guess, what you mean, what you have in mind when you're thinking about risk. So if you're thinking about it from an international portfolio allocator's perspective, then it becomes really important to focus on placing your bets of your exposures of your portfolio to markets that are much more likely to be on an upward trajectory than on the lower end of the divergent trajectory. So that's from a portfolio allocator's perspective. From a more economic fundamental perspective, I think that the big concern is that governments, policymakers don't take seriously enough the importance of rolling out vaccination, because I think it has become amply clear that the process of managing the pandemic purely on the basis of lockdowns and masking and contact tracing and social distancing is not going to be sufficient. We have the technology. What we need to do now is we need to roll it out, even if it is a so-called inferior technology. For some countries, they don't have access to the Mercedes-Benz of vaccines, right? So that's the Pfizer or the Moderna vaccines. They have something of a lesser nature, but nevertheless, once you have a certain degree of immunity in your population, you become a lot more comfortable in opening up and treating COVID much more like you would the annual flu epidemic. And when you have that shift in mindsets, that is no longer going to be something that leads to lockdown because of exponential growth of these diseases. And you can only ensure that the exponential growth won't come to pass when you have a sufficient amount of vaccination in your population. That is when I think economies will return to some degree of normalcy. Socially, we will still have problems. We will still, I suspect, based on the scientific understanding, that eventually will evolve such that if you're outdoors, you'll probably be okay without wearing a mask. And actually, it's indoors where masks will become a lot more important, even though arguably it's more uncomfortable when you're in the office to be wearing a mask. But that's where it can actually spread a lot more easily than when you're outdoors. Likewise, this idea of scaling back, I alluded to this in my talk, scaling back and shutting down just for 20 or 30 cases, hopefully, the reason why we're doing it now, I think, is because we don't have that kind of coverage. So there is still a risk that we will that this process starts to become exponential. But if you're comfortable in that you have 60, 70% coverage in your population, then what you would have is that you will have an at-risk population, some of which cannot be vaccinated for whatever reasons, and others who refuse. and those are the ones that arguably you have to kind of have more public education campaigns and so on. And then we'll be comfortable in saying, okay, we're not going to shut down the economy every time we have 30 cases. That 30 cases is far less than the number of people who die from the flu. So that's my view.
Thank you. We've got a question from Vivian. With digitalization and technology adoption getting fast-tracked last year, particularly because of the pandemic, what impacts do you foresee on human capital flow and the impact on low, medium skilled jobs and the future of that whole vexed topic of manpower in Singapore?
Okay, I think where Vivian is trying to get at is this concern that you are now going to see basically global competition for talent, such that when you have one individual that is, okay, if you are the top of the global distribution, you don't have to worry. You're it's the economics of superstars, right? You're the J-Lo or the or I'm trying to think of other Michael Jordan of the world. So you don't have to worry about being replaced. But the concern is the bulk of people who are good within their country, but potentially not might face problems with being arbitraged out by someone who may be lower cost in another country operating in the same knowledge sphere as they are. That's when I think you must keep in mind that there are, of course, paper qualifications, and then there is a deep knowledge of your area because of your knowledge of the region, of the market. That's why I think that market knowledge is critical. That still makes you deeply valuable as compared to someone from another country who isn't living and breathing in that particular market. So that's one point that's important to keep in mind. The other important point to keep in mind is that we have to recognize that there are elements of social skills that sometimes don't come across as easily. We often, being in Asian society, we often think in terms of education and paper qualifications. But actually, social skills are extremely lucrative, and social skills and sharpening those social skills, maybe I shouldn't just use social, but soft skills becomes an important way to stay competitive and relevant, and in a way that isn't as easily outsourced.
Yeah, and that brings us back to the comments we were making earlier about attitude, because these are core life skills that are just so important. Moving on to another topic of interest, the US-China technological decoupling. We read so much about it. What are your thoughts on that, and what do you think? How does that leave Singapore, a small city state?
So to some extent, this is a little bit of the legacy of the Trump administration. It has led to a much greater sensitivity by China that they need to develop a certain amount of economic independence. And it's a bit ironic because in some ways, they were the weaker economic power going into the process. And you would think that actually they were the ones that might want to engage more in protectionism as opposed to the United States, but it was actually the other way around. And so the thing that's important to remember about China is just the sheer, I keep going back to this, but the sheer number of people there are, right? But why this is relevant for innovation as well, it's because when it comes to innovation, you just need one Einstein, you just need one Newton to generate an idea that then gets replicated effectively costlessly, right? The idea itself gets replicated costlessly. So innovation in that sense will always favor numbers, the law of large numbers. In the case of, and that's the case in China as well, especially when they start to allow for much more meritocracy in terms of you can be anyone. You can be someone from the rural areas of China. You can be someone from a small village in just on the outskirts of some of the large cities, and yet there's a mechanism if you are ambitious and bright to actually rise and seize those opportunities. I'll say the same for India too. So when it comes to these kind of technological innovations, it will always favor these relatively larger economies. Now, where that leaves something like a country like Singapore, once again, is an ability to then adapt and localize. So it's never the case that a general technology can easily be rolled out, even in cases when you think it should be fairly straightforward, right? Like ride sharing. It's a simple technology. It's about basically being able to track where your driver is and to hail and to match your driver with a passenger and to roll it out. But yet we saw that Uber wasn't able to compete in China, and it lost fair and square to other mechanisms, other competitors. And why is that? It's because there was a greater ability of TT to actually localize the product to the Chinese market than Uber was able to, even though the underlying technological principles are comparable. So that's the thing. In Singapore, likewise, if you or if I may suggest, if you're looking at the region, then it's critical that you learn how to adapt to the local markets. And we see this. In fact, Grab has these Grab for motorcycles in Vietnam, in Indonesia, which obviously isn't relevant in Singapore, but that simple adaptation has made Grab very relevant in these markets, as opposed to just the traditional models that we're used to.
Thank you. Paul asks, could you please share your thoughts on cryptocurrency and their contribution or threat to existing economic models?
Yeah, so I'm not a crypto fanboy, I'm afraid. What I will say is this: the biggest risk, not so much from cryptocurrency, but to cryptocurrency, is regulatory disintermediation, by which I mean all it takes is for central banks to just decide they're going to have a central bank digital currency. Some central banks already have decided on this and have rolled them out. And you very rapidly disintermediate the function of a cryptocurrency from just about every other, from most of its functions, and with perhaps the exception of if you want to get some ransom from having planted some incriminating spyware on someone's computer. So there will always be a role for gray and black economy functions for cryptocurrency because of the anonymity. But in terms of functional use, I think they'll be rapidly disintermediated. And honestly, from other perspectives, like an environmental perspective, it absolutely does not make sense. And in fact, within cryptocurrency, if I had to point to one of its main weaknesses, is that it will die by its own hand. The very thing that makes cryptocurrency inherently so-called valuable is the fact that it is able to constrain itself in terms of scarcity. So by its design, there will only be a fixed number of Bitcoins in the world, but hence by that design, it will always constrain its use as a currency, for which one of the users of a currency is as a medium of transaction. It doesn't displace perhaps the use of Bitcoin at that scarcity may well be valuable as a store of value, and in that sense, it has found its way into some financial portfolios, including institutional portfolios. But its role there is very much like the role that gold plays, which is it doesn't fulfill a pure economic function, but it just fulfills a diversification function to cushion returns in a large diversified portfolio.
Thank you. I just want to maybe touch on an issue. Edith has asked a good question. So how do you explain the lack of productivity in Singapore?
Okay, that's not just a 5 or 50 or $500 million question. It's probably worth billions of dollars. The government has if you look at the history of productivity, boards and commissions, we have had it since the 1970s. If I had to put my finger on it, and of course this reflects my biases as an educator, I think it stems from the freedom to think beyond the boundaries in everything in daily life, which then spills over into the way we think beyond the boundaries in innovative exercises. So what do I mean by that? Here's a very simple example. In Singapore, think about when you can make a U-turn. The sign tells you when you can do it. In most other countries, or countries I'm familiar with, sign tells you when you can't do it. So it's permitted unless otherwise prohibited. It's the opposite here. It's prohibited unless otherwise permitted. So the mindset of the average Singaporean isn't to think about what we can do, what is permitted. Now, okay, if you have been in the army, you know that lots of things, the mindset in the army is everything is permitted, just don't get caught, right? So it's not that no one tries to push the boundaries of what is permitted, but nevertheless, it does inhibit, I think, our ability to think innovatively. Because remember, I alluded to this at the end of the talk, most innovation isn't going to be of the earth-shattering variety, right? Most of us are not going to invent a light bulb or the next kind of a Pfizer vaccine, if you will. Most of us are going to do incremental innovation that adapt a given product a little bit better to its local context. And this kind of little tinkering, marginal innovations, process innovations, this is important for generating productivity. But if we never have that mindset, if we don't carry that mindset routinely as part of what we do, if we're always looking to provide the model answer rather than providing an answer and then saying how my answer could be different and why that different answer is perfectly legitimate as well, and having examiners accept that alternative answer as just as relevant as the so-called model answer. Until we're there, I don't think we will be able to elevate our inherent sense of inventiveness. It's not that Singaporeans don't have it. We have it, then we get it hammered out of us.
Yeah, which is sad. And let's close because time is running out. You know, all over the world, talent is in short supply. Do you think that automation and robotics, even cyborgs, are going to be the methods that will plug those talent gaps for societies, whether we're talking here in Singapore, whether we're talking in China, whether we're talking in Europe? What do you think? Because talent is in such short supply everywhere. And I think one of the audiences alluded to the fact that, you know, we are a very rapidly aging population ourselves here in Singapore.
I don't actually think so. I'll start by questioning that premise that talent truly is in short supply. Certain types of talent are in short supply. If you are trying to hire the next Andrew Yang, who apparently I went to school with, but if you're trying to hire
we've lost you, James. I think you've your screen has frozen and we can't hear you. This must be a bit of technology running amok. We'll just give it 1 minute, and if not, we'll close, because we are getting very close to the end of our session. Yeah, it doesn't look like we're going to get James back. So, ladies and gentlemen, I want to thank you for joining us today. I want to thank our guest, who I hope is trying to reconnect, but if not, I want to thank him for his time. I'm sorry we weren't able to take all the questions, and some of them had a particularly political slant, but we are having an economics section today, so maybe you can park some of those questions for our next distinguished speaker, who will be the Leader of the Opposition, Mr. Pritam Singh, a month from now on the 8th of July, all being well and the pandemic permitting. So really, from all of us at SICC, thank you so much for your company. Stay in touch. If there's anything my team or I can do for you, you know how to reach us, here to help at sicc.com.sg. Thank you so much, and goodbye.